You are wasting your time trading the markets when you should be owning the platform that hosts them. In 2026, over 95% of retail traders lose money, but the brokerages facilitating those transactions collect fees on every single trade regardless of the outcome. To build real wealth, you must shift your position from the speculative player to the infrastructure operator. We are going to break down exactly how to claim your cut of this multi-billion-dollar industry without the traditional $500,000 capital requirement. This is your operational blueprint to building, launching, and scaling an asset-light trading platform business. You will learn the hidden plumbing of retail brokerages, the mechanics of liquidity routing, and how to deploy your own fully branded platform. We will dismantle the gate-kept barriers of the financial markets. This is the masterclass your broker hoped you would never watch. Let us start where beginner finance advice ends by ignoring the tired cliches of saving money and compound interest. To run a high-margin enterprise, you must understand margin, the minimum collateral required to keep an active leveraged position open. If you only look at the market as a retail buyer, you are blind to the massive fees flowing through the back end. In 2026, the real money is made in the plumbing, specifically through spreads and commissions. You need to learn how to capture this flow directly. Every retail transaction is processed through one of two models, the A-book or the B-book. An A-book model routes trades directly to external liquidity providers, financial institutions that stand ready to buy and sell assets. In contrast, the B-book model means the broker takes the opposite side of your trade, acting as the counterparty. This means when the trader loses, the B-book broker profits directly. Managing a B-book requires massive risk management infrastructure to ensure a single winning trader does not bankrupt your entire operation. Let us examine how a standard brokerage structures its revenue flow from unsuspecting retail accounts. Traders deposit funds into segregated client accounts, which the broker must hold separately from operational cash to prevent fraud. The broker then routes some trades to liquidity providers while keeping the rest on their own book. They collect a markup, an extra fee added to the market price of an asset on every single order. This diagram illustrates the flow of capital from the user's click to the operator's vault. To launch a traditional brokerage, you must first secure regulatory capital, the emergency cash reserves a broker must keep to prove they will not go bankrupt. Regulators like the Financial Conduct Authority in the UK require up to 730,000 euros in upfront capital just to apply for a basic license. If you attempt to operate without this, you face immediate shutdown and potential criminal prosecution. This regulatory barrier keeps ordinary entrepreneurs completely locked out of the financial markets. It is a system designed by institutional giants to protect their own monopoly. Beyond licensing, the physical technology stack will drain your bank account before you execute your first client trade. A single MetaTrader server license historically cost upwards of $100,000, plus ongoing monthly maintenance fees to Meta quotes. You also must pay for bridge software, which connects your trading terminal to your external liquidity pool. This setup requires dedicated network engineers on standby 24 hours a day. One minor server glitch can result in thousands of dollars in execution, disputes with angry clients. Liquidity providers do not work with unproven startups, meaning you cannot easily access real-time price feeds. They require a prime brokerage relationship, which often demands a minimum deposit of $50,000 just to clear trades. A prime brokerage is a specialized financial institution that bundles services like clearing and leverage for institutional clients. Without this, your platform will suffer from massive execution latency, the delay between a trader pressing buy and the order executing. High latency causes slippage, which ruins the user experience and drives your traders to competitors. Consider the case of Alperi UK, a major retail broker that collapsed during the Swiss National Bank Black Swan event in 2015. When the Swiss franc peg was suddenly removed, massive market volatility wiped out client balances, leaving the broker with millions in unpaid negative balances. Because Alperi had to settle these trades with their prime brokers, they ran out of capital and filed for insolvency within hours. This demonstrates that even established brokers are constantly exposed to catastrophic counterparty risk. If you do not manage your exposure perfectly, one market spike will wipe you out completely. To mitigate these risks, traditional operators spend thousands on sophisticated risk management software. This software monitors toxic flow trades from highly profitable arbitrageurs who exploit price feed delays to drain the broker's liquidity. If you do not identify and block toxic flow immediately, professional trading groups will bleed your B-book dry in days. This forces you to engage in a constant cat-and-mouse game of adjusting spreads and execution speeds. It is an exhausting, technical battle that requires deep industry expertise to survive. You must also establish corporate banking relationships, which is incredibly difficult for any business handling retail trading funds. Most Tier 1 banks will instantly reject your application due to strict anti-money laundering regulations. This forces startups to use offshore banks in jurisdictions like Vanuatu or Mauritius, which charge exorbitant transaction fees. These banks often require physical visits, extensive corporate documentation, and months of waiting before approval. If your bank account is suddenly frozen, your entire business grinds to a halt instantly. Let us look at the numbers behind retail trading growth. Despite the high failure rate of traders, the aggregate volume transacted globally has surged consistently over the past decade. By 2026, the global retail foreign exchange market average daily volume has surpassed $1 trillion. This chart illustrates the explosive trajectory of retail volume, proving that the demand for trading platforms is larger than ever. The opportunity is not in predicting where the currency is going, but in owning the digital venue where the transaction occurs. Instead of building a broker from scratch, many smart operators choose to purchase a white label solution. A white label is a product made by one company that other companies rebrand and sell as their own. In the brokerage industry, this means renting space on an existing broker's server and regulatory umbrella. This reduces your startup cost from $500,000 down to roughly $10,000 or $20,000. However, traditional white labels still come with severe structural limitations that you must understand before signing any contract. With a standard white label, you do not actually own your client database. The primary broker hosting your platform can see every single user you acquire, including their contact details and trading habits. If that broker decides to shut down your brand or raise their fees, they can easily poach your clients directly. You are essentially acting as an unpaid marketing department for another company while bearing the reputational risk. It is a highly asymmetric deal, where the platform provider holds all the cards. You must also navigate the complex web of offshore jurisdictions if you want to avoid immediate regulatory crackdowns. Many traditional white label brokers register their entities in St. Vincent and the Grenadines or Vanuatu. While these locations have minimal capital requirements, they offer almost no protection for retail traders, making client acquisition difficult. In 2026, global payment processors are heavily restricting transactions to offshore entities, making it nearly impossible to collect credit card deposits. This forces you to rely entirely on crypto gateways, which can alienate non-technical traders. Let us examine the traditional timeline of setting up a standard white label brokerage. Historically, the process took months of corporate filings, bank account setups, and platform testing. If any step failed, you lost your non-refundable setup fees to the primary broker. By 2026, this slow, bureaucratic pipeline has become a massive liability for agile fintech startups. This timeline maps the grueling path of the legacy setup, showing why so many modern operators quit before they ever launch a single live account. The next major hurdle is marketing cost, specifically your client acquisition cost, or CAC. In the highly competitive retail trading sector, acquiring a single funded trader can easily cost over $500 in paid advertising. If your white label provider takes a massive cut of your spreads, you will struggle to achieve profitability. You are caught in a pincer movement of rising ad costs and shrinking operating margins. To survive, you must find a way to acquire users organically, or build a highly active education community. Most successful platform owners do not rely on cold traffic. They build an audience first through structured education. By teaching people how to navigate the financial markets, you build deep trust and establish authority. Once those students are ready to trade live, you direct them to your own fully branded platform. This strategy reduces your customer acquisition cost to practically zero. You are monetization-focused, turning your educational content directly into a highly profitable B2B infrastructure business. To maintain absolute trust, you must clearly distinguish between platform operations and financial advice. You will never tell your users what trades to take or promise them specific financial returns. Instead, you provide them with superior execution speed, clean user interfaces, and robust charting tools. Your role is solely that of an infrastructure provider, like a landlord renting out retail space. If a user loses money on a bad trade, it is their responsibility, not yours. This clear division of labor is essential for protecting your brand and staying compliant with global regulators. Let us examine a real-world document demonstrating the strict regulatory oversight on unauthorized financial promotion. In this warning memorandum, a major financial regulator highlights the legal penalties for platforms that cross the line into offering unlicensed trading advice. By remaining strictly in the camp of technology and infrastructure, you insulate your business from these devastating enforcement actions. Read this carefully. You must always remain an infrastructure provider, never a financial advisor. Let us address the massive overhead disparity between the traditional, old-school brokerage model and the modern, asset-light cloud operator. A traditional broker faces crushing fixed costs, including physical offices, compliance departments, and expensive back-end servers. A modern operator bypasses these expenses completely by using optimized white-label infrastructure. This split comparison shows why legacy brokerages are struggling to compete with lean, highly agile platforms in 2026. By keeping your fixed costs near zero, you can survive market downturns that would bankrupt a traditional firm. Let us look at how the global hubs of retail finance operate, starting with Cyprus, the absolute capital of retail brokerage technology. Hundreds of online brokers are registered with the Cyprus Securities and Exchange Commission, known as SEC, due to its favorable tax rates and European passporting rights. Passporting allows a firm regulated in one EU country to legally serve clients across the entire European Economic Area. This globe view marks the strategic importance of Limassol, where the modern retail brokerage industry was largely built and scaled. Another emerging financial jurisdiction you must watch is Labuan, Malaysia. This midshore island provides a highly attractive regulatory framework for digital financial services, offering low corporate tax rates of just 3% on audited net profits. Many sophisticated white-label providers use Labuan entities to legally bridge the gap between Asian liquidity and Western platforms. This map highlights Labuan's strategic position, which serves as a critical gateway for operators targeting the massive, fast-growing markets of Southeast Asia. To build a truly sustainable digital business, you must eliminate payment friction for your users, especially in emerging markets. In countries across Africa and Latin America, traditional bank transfers are painfully slow, and credit cards are rarely used for international transactions. This is why stablecoins have become the absolute standard for retail platform funding in 2026. By utilizing USD, a stablecoin pegged to the US dollar, your users can deposit and withdraw funds instantly without worrying about conversion fees or banking delays. It is a borderless system that works 24 hours a day, 7 days a week. When handling user deposits, you must understand the difference between TRC20 and BEP20 transfer protocols. TRC20 is a token standard on the Tron network, which is highly popular for retail deposits due to its widespread adoption on major crypto exchanges. However, for a platform operator managing high-frequency payouts, the Tron network's transaction fees can add up rapidly. That is why modern platforms are transitioning to BEP20, which is a token standard on the BNB Smart Chain. BEP20 offers incredibly cheap gas fees, making it highly efficient for sending automated payouts of any size. Let us talk honestly about the absolute nightmare of manual payout processing. If your platform requires you to manually review and approve every single withdrawal, you will quickly become a slave to your own business. You will spend hours verifying blockchain addresses, paying manual network fees, and dealing with support tickets from anxious users waiting for their money. This manual overhead is the primary reason why most early-stage platforms fail to scale. You must deploy automated smart contract-driven settlement rails to handle this operational burden for you. To solve this, we must look at how the modern VARJIX architecture is structured. VARJIX is a completely free white-label trading platform infrastructure built on top of Deriv, one of the oldest and most liquid brokerages in the industry. As a VARJIX operator, you can launch your own fully branded trading platform in about 30 seconds with zero code, no expensive broker license, and absolutely no back-office management. This allows you to focus 100% of your energy on client acquisition and brand building, while the heavy financial and regulatory plumbing is handled entirely in the background. Let us look at the exact revenue model behind VARJIX to understand how you make money. VARJIX is completely free to launch, meaning there is absolutely no subscription fee, no monthly platform cost, and no hidden pricing tiers of any kind. Instead, earnings are generated from a highly transparent 3% markup applied to the stake of each real trade by the primary broker. This markup is split automatically. The operator always keeps 60% of the markup, and VARJIX keeps 40%. This universal split ensures that both you and the infrastructure provider are perfectly aligned to scale. This model is incredibly elegant because you never take any direct market risk. When a trader on your platform executes a transaction, you do not act as the counterparty, meaning you do not lose money if they win. Your revenue is tied entirely to trading volume, which means your goal is to build an active, highly educated community of traders who trade consistently. This eliminates the massive financial liability of the B-book model, while preserving the high-margin upside of a premium brokerage business. VARJIX offers highly polished, live platform templates including Velocity and Solo Trading Elite. These interfaces are fully responsive and optimized to convert retail traffic in high-growth regions like Africa, Latin America, and Southeast Asia. Every platform you launch also includes a completely free practice mode hosted at your subdomain.varjix.com/sandbox. This sandbox environment runs on the trader's own Deriv demo account, allowing them to practice with real-time market prices using virtual funds. This is a massive educational tool that allows you to train your audience safely. You can use this risk-free sandbox mode to record educational video tutorials and run live webinars without ever risking real capital. It is the ultimate tool for building trust with beginner traders who are intimidated by live markets. When your students are ready to transition to real trading, they can upgrade to a live account with a single click. This seamless onboarding flow dramatically increases your conversion rates and drives high volume, long-term activity on your platform. You are building an asset-light fintech empire from your laptop. Let us talk about how payouts are processed, which is the most critical component of your operational cash flow. Earnings accrue from the first day to the last day of each calendar month, and the closed month is settled between the 12th and 18th of the following month. Previously, operators had to request a withdrawal manually and pay high network gas fees, which made collecting small balances highly uneconomical. From the August 2026 cycle onward, this friction has been completely eliminated by an automated on-chain payment rail. Under the new August 2026 system, settlement is sent automatically on-chain directly to each operator's BEP20 UST wallet. There is absolutely no withdrawal fee deducted, and balances from as little as 1 cent upward are transferred without any manual request required. This means even if you are just starting out and only earned $5 this month, you will receive your exact funds directly to your wallet on autopilot. This is a game changer for digital operators in emerging markets, allowing you to reinvest your revenue instantly without losing margins to transaction fees. While automated payouts are processed via BEP20, your traders can continue to make deposits using TRC20 UST, which remains the industry standard for retail funding. This hybrid model gives you the absolute best of both worlds: maximum convenience for your users and maximum cost efficiency for your business. You do not have to worry about managing liquidity pools or paying network gas to distribute earnings. The entire back-end execution is handled by the primary broker's institutional infrastructure, leaving you with pure, stress-free profit. In addition to your direct platform revenue, VARJIX includes an incredibly powerful 2-level referral program to expand your distribution. When you refer another operator to the platform, you earn 10% of their platform's generated markup on level 1 and 5% on level 2. This allows you to build a powerful network of subplatforms, earning passive revenue from their traffic as well. It is an exponential growth engine that rewards you for educating other entrepreneurs and expanding the overall ecosystem. To assist you in scaling your operation, VARJIX also features an advanced AI growth and co-pilot agent. This agent analyzes your platform's volume, identifies where your users are dropping off in the onboarding funnel, and suggests targeted educational campaigns to boost engagement. It also includes a public API and a custom model context protocol server, known as an MCP server. This allows technical operators to connect their platforms directly to external databases, custom trading bots, or proprietary charting tools.
Let us look at a brilliant piece of business wisdom from legendary investor Warren Buffett, who famously stated that if you do not find a way to make money while you sleep, you will work until you die. Speculative trading requires your constant presence, emotional energy, and screen time, making it a high-stress job rather than a true business. By transition to owning the platform infrastructure, you are building a system that generates revenue 24 hours a day from other people's trading activity. You are finally aligned with the wealth-building mechanics of the world's richest individuals.
Now, let us address the exact excuse you are already making to avoid taking action today. You are likely telling yourself that the market is too saturated, or that you do not have enough technical knowledge to run a digital platform. But the reality is that VARJIX has completely eliminated the technical barrier, and the global demand for trading platforms in 2026 is at an all-time high. Your hesitation is not a lack of opportunity. It is a fear of shifting from a consumer to an owner. You must break this cycle of hesitation immediately. I am giving you a direct, non-negotiable command that you will complete within the next 48 hours. Go to VARJIX, launch your own fully branded trading platform using either the Velocity or Solo Trading Elite template, and set up your custom domain. Once live, record your very first educational trading tutorial using your sandbox environment and share it with your existing audience or community. Do not overcomplicate it, do not make excuses, and do not wait for the perfect moment. The infrastructure is ready, and the only missing component is your execution. Stop playing the speculator's losing game and start positioning yourself as the platform owner today. Build your digital infrastructure, scale your brand, and secure your financial future. Subscribe to VARJIX right now to unlock our next operational masterclass and stay ahead of the changing retail trading landscape.